In this video, I aim to detail several highly effective price action strategies that I routinely apply across different financial markets. Taking a closer look at the price action, we sometimes see a pattern where small candles with ideally short shadows line up closely, forming a narrow channel. These candles are usually the same color, and they tend to either touch the trend line or come very close to it. These extremely tight channels, which we call micro channels, don't have any pullbacks within their bounds. Micro channels usually feature 3 to 10 candles. Personally, I've found that the ideal range often lies somewhere between those two thresholds. Some traders view micro channels as a sign of strength in a trend, but this isn't a strict rule. While it's true that consecutive micro channels can sometimes signal the start of a strong trend, in my experience they aren't particularly common in the markets. When they do occur, they're typically more useful for gaining insights into the market's structure than for providing a clear-cut trading strategy with precise entry and stop-loss points. Before we discuss strategies for trading microchannels, it's essential to remember that not all patterns that look like microchannels are actually tradeworthy. For instance, take a look at this pattern here. You'll notice that most candles have long wicks, and they resemble doji candles. This is a key signal that they're not really fit for being labeled as a microchannel. When trading this pattern, we typically scout for small price swings and stick to trades where the reward-to-risk ratio is no more than 1 to 1.5, even though this strategy was initially crafted for fast scalping on smaller time frames like the 5-minute chart. It's still quite practical on larger time frames, as long as we take into account all the factors we've talked about. Typically, there are 4 primary scenarios to consider when trading in a microchannel. The first scenario arises when the prevailing market trend is upwards, and the microchannel mirrors this trajectory with its own ascending slope. In scenarios like these, we focus solely on buying opportunities, aligning with the market's prevalent uptrend. However, identifying the market trend through simple observation can be quite subjective. It's interesting to note that various traders might have their own unique interpretations of the situation. Using long-period moving averages can indeed reduce the ambiguity in identifying market trends. The simple moving average with a period of 50 days is a common choice, as it smooths out price data over a significant time frame, providing a clearer picture of the overall trend. But you might prefer different settings based on your personal trading history, past experiences, or the results from backtesting strategies on specific assets. When the price is above the 50 SMA and the microchannel is trending upwards, we aim to enter a long position only if a candle dips below the low of the candle before it. This strategy is based on the assumption that such a downward pullback is temporary and the market is likely to continue its upward journey soon. We then place our stop loss just below the low of this candle and set a take-profit target of either 1 or 1.5 times our initial risk. As we can observe, the market climbed significantly higher than our initial speculation. In light of this, adopting a 2-step approach to taking profits could potentially enhance our money management strategy in such scenarios. This method allows us to secure some gains while still allowing room for additional profit if the market continues to rise. In the second scenario, we again find the price comfortably above the 50 SMA, signaling an uptrend. However, this time the slope of the microchannel is downward. In this context, our strategy diverges from the previous one. Here, we aim to initiate a long position when a candle's high surpasses the high of its preceding candle. Remember that the candle that violates the order of the microchannel is better off being of the opposite color, which in this case is green. This is because this scenario incorporates some elements of a counter-trend strategy. In contexts such as these, the price movement following an exit from the microchannel can sometimes be quite substantial. You might see a second leg equal to the first one, which signifies exceptionally high momentum. If you have followed me thus far, you have probably guessed what bearish scenarios might entail. However, to ensure we cover all aspects of microchannels in different market situations, I will provide only brief explanations for each bearish situation. In the third scenario, where the price is below the 50 SMA indicating a downtrend, the slope of the microchannel aligns with the dominant trend. Therefore, we only consider short entries when a candle makes a high above the previous candle's high. Lastly, in a bearish trend with the microchannel sloping contrary to the trend, we should only enter short positions when a candle records a lower low than its predecessor. The strategy known as pre-breakout accumulation stands strong on its own. That said, it also plays a key role in reinforcing various other price action strategies, significantly boosting their potential for success. Take a look here. You'll notice that the gold price picked up its prior uptrend after a significant pullback. But then, out of the blue, its ascent pauses, and it settles into a consolidation phase. It's as if gold took a breather before deciding on its next move. Let's zoom in on the price action near that resistance zone. Upon its first encounter, the price distinctly pulls away, leaving behind a long wick, a clear sign of rejection. However, with subsequent approaches, this pushback lessens. Eventually, we observe a series of weak candles queuing up just beneath the resistance, hinting at waning selling pressure. It's almost as if the market is hesitating, building up suspense before the next big price move. Furthermore, it's quite interesting to see that despite its efforts, the price just can't seem to break through that bullish trend line. It doesn't even dip below the low of the last significant swing low in the market. Now, this stubbornness shapes up into what we call an ascending triangle. This is a pretty solid sign that things might keep climbing. This pattern is like a green light, telling us that all the pre-breakout buildup is checking out the right boxes. So, if this breakout plays out as it usually does, we're likely in for another ride to the upside. After the breakout occurs, we typically expect a significant candlestick break above the resistance zone. Traditionally, we would then look for a pullback to the breakout level as an opportunity to enter the trade. However, in scenarios with pronounced price momentum, like this one, the market may not offer a second chance. We can often predict this intense momentum if we observe a large candle with a long lower shadow and minimal or no upper shadow. Traders often find it challenging to differentiate between an authentic pre-breakout pattern and a deceptive one, especially when they do not pay close attention to price action around the resistance area. For further clarity, let's juxtapose the second scenario against the one previously discussed. In this scenario, every price attempt to surpass the resistance zone results in the formation of prominent bearish candles, often with long upper shadows. It serves as an alarm signal. Such market behavior could suggest that the observed pattern is more of a misleading cue than an authentic pre-breakout accumulation. Furthermore, a key aspect of the second situation is when the price breaks its bullish trendline, which might signify an impending market reversal. Also, when the market passes and closes below a major swing low, it confirms the likelihood of a trend change. In addition, the market demonstrates a pattern of lower lows and lower highs, which is a hallmark of a bearish trend. Taking into account all these indicators together, it's clear that although there may be resemblances to the first scenario, this pattern should not be interpreted as a valid pre-breakout accumulation. Rather, it seems to be an indication of a possible trend reversal. Occasionally, you'll see a surge of green candles on the chart, suggesting that the price has just made it past a resistance zone. When traders spot this, it often boosts their confidence to go ahead with a breakout strategy. Often these traders will set their stop losses just a bit below this resistance zone, believing they've allowed enough buffer. However, smart money know that these common stop loss placements are not strategically positioned. They lack adequate cover below a significant swing low. The smart money may then aggressively push the price down beneath the resistance zone to target liquidity zones. This is usually where a cluster of stop-loss orders awaits. This action triggers a cascade of trades. To avoid getting caught in this, a tip is not to set your stop-loss too close to your entry point. Instead, a safer measure is to place your stop-loss below a major swing low. Also, keep an eye out for rebound signs below the resistance level. A clear sign of a significant liquidity zone hit is a robust rejection, like when a large bullish engulfing candle emerges, towering over many candles behind it. This could indicate that the market's pullback phase is almost over, and that the smart money might be getting ready to make a move. While supply and demand concepts can provide us with ways to spot these reversal zones on the chart, we're not diving deep into those today. However, other signals can also validate these areas. For instance, a divergence between the price movement and the RSI indicator can strengthen the case for a smart money entry. If you miss the initial opportunity, stay alert for a second chance. If the price approaches the trend line drawn through significant lows, it may be a good time to enter the market. So, while using this strategy, always think about these questions. Where are the bulk of stop losses set by other traders? Have they moved their stops to break even? Is there a clear rejection suggesting demand zone activity? Finally, once the smart money finishes accumulating, it often marks the beginning of a sustained upward trend. That's your cue to adjust your stop loss to a more favorable position, as the smart money's wash and rinse trick is likely to have played out. We've covered a lot today, and I hope you're leaving with some actionable insights. Don't forget to like, share, and comment below with your thoughts or questions. Stay disciplined and watch your trades grow.